All right, let's talk about something that can be a real headache for asset owners in the UK, capital gains tax. Now, I know, it doesn't exactly sound like the most thrilling topic, but trust me, getting this wrong could be one of the costliest mistakes you ever make.
Have a look at this number, £26,600. What does that make you think of? A deposit on a flat? A brand new car? Well, what if I told you this was actually a tax bill? A bill that wasn't for selling something, but for giving it away.
Sounds completely backwards, doesn't it? The idea that a generous gift to a loved one could land you with a massive tax bill is, well, it's a very real risk. Over the next few minutes, we're going to unpack exactly how this can happen and, more importantly, how you can make sure it doesn't happen to you. This whole breakdown comes to you from the experts at My Tax Accountant, and they see this kind of thing happen all the time. The problem is that when you give away a valuable asset, the taxman doesn't see it as a simple gift. Oh no. The rules change, and that's where people get caught out.
So, here's our game plan. We'll start with the story behind that whopping £26,600 bill. Then we'll get into the nitty-gritty of the market value rule. After that, we'll look at how to value property, and then other treasures like art and antiques. We'll cover what HMRC expects from you, and finally, we'll map out how you can handle all this with total confidence.
Right, first up, let's get straight to that shocking price tag. How in the world can a gift cost so much in tax? Well, let me show you a perfect real-world example.
Meet Adrian. He wanted to do a wonderful thing and help his daughter out, so he gifted her a property he owned. Amazing, right? Not a single penny changed hands. But in the eyes of HMRC, the tax authority, well, they saw it very differently. They treated it as if Adrian had sold the property for its full market value, £300,000. After taking away what he originally paid for it plus some costs, he was left with a taxable gain of £95,000. And at the property tax rate of 28%, that landed him with that staggering bill of £26,600. So the big question is, why?
The answer, and the key to avoiding this whole mess, is all down to one fundamental principle in UK tax law. It's called the market value rule. And it's the reason a simple gift just isn't simple for HMRC.
Now, the official definition is right here. Market value is the price which those assets might reasonably be expected to fetch on a sale in the open market. The keywords there are might reasonably be expected to fetch. It's got nothing to do with what you actually got paid, which, in Adrian's case, was zero. This rule is there to stop people from, say, selling £1 million house to their son for £1 just to dodge tax. It makes sure tax is paid on what an asset is truly worth, and it gets triggered when you deal with what's called a connected person.
So who counts as connected in HMRC's book? Well, the list is pretty broad. It's not just your husband, wife, or civil partner. It's your parents, your kids, your brothers and sisters, even your in-laws. Basically, if you gift or sell an asset for less than it's worth to anyone on this list, boom, the market value rule kicks in automatically.
This really lays it out clearly. If you sell to a stranger, it's simple. The tax is based on the actual price you both agreed on. But the moment you gift that same asset to a relative, HMRC creates this deemed sale at full market value. You end up getting taxed on money you never even saw. And that, right there, is the crucial difference. Okay, so we know this market value rule is a big deal. The next logical question has to be, how on earth do you prove what that value is? Especially for something as valuable as a house, you need a valuation that HMRC will actually accept.
And here is a massive pro tip for you, one that could save you a world of pain. That quick, free valuation you get from a local estate agent when you're thinking of selling, yeah, that is not going to cut it for HMRC. For tax purposes, they need something much more formal, much more detailed. It has to be a professional valuation that can be defended.
The gold standard for this sort of thing is a valuation carried out by a qualified surveyor who follows the strict standards of the Royal Institution of Chartered Surveyors. You'll see it referred to as RICS. Think of a RICS valuation as the official HMRC-approved version. It's what they expect to see. Now, these rules don't just apply to bricks and mortar. Lots of us have other valuable items, right? Maybe a painting, an antique watch, or some jewelry. In the world of tax, these are called chattels. And stay with me here, because the rules for these have some really interesting quirks you'll want to know about.
So, what on earth is a chattel? Put simply, it's any tangible, movable thing you own. You know, the kind of stuff you'd see on Antiques Roadshow, furniture, paintings, collectibles, that sort of thing.
Now for another really handy pro tip. This is a big one. It's called the chattel exemption.
If you sell or dispose of a single chattel and you get £6,000 or less for it, any profit you make is completely exempt from capital gains tax. That £6,000 threshold is a key number to remember.
But what happens when you sell for more than that magic number? Let's walk through an example. Imagine you sell an antique table for £9,250. Your original costs were £2,350. So your actual gain, your profit, is £6,900. You might think you'll just pay tax on that full amount, but hang on, there's a special rule that can really help you out.
This special rule is called marginal relief, or sometimes the 5/3 rule. Now it sounds complicated, I know, but let's just break it down with the numbers on the screen. It's pretty simple, really. First, you work out how much your sell price went over the £6,000 limit. In this case, that's £3,250. Next, you multiply that number by 5/3, which gives you £5,417. Finally, you compare that figure to your actual gain of £6,900. Your taxable gain is the lower of the two, so you're only taxed on a gain of £5,417, not the full £6,900. It's a really valuable bit of relief.
Okay, so whether we're talking about a house or an antique, the main point is the same. You need a credible, professional valuation. So what does HMRC actually look for? What makes for strong, defensible evidence of an asset's true value?
Well, HMRC's own valuers have a clear hierarchy, a pecking order for evidence. At the very top, the absolute best proof is Category A, direct comparable sales. This means looking at recent real-world sale prices of assets that are almost identical. After that, you've got more general market data in Category B and other stuff in Category C. A really solid valuation will always be built on that top-tier Category A evidence.
Phew! We've covered a lot of ground here, from the shock of a tax bill on a gift all the way to the nitty-gritty of valuations. So let's just boil all of that down into a few key takeaways to give you a clear path forward. If you remember nothing else from our chat today, please remember these three things. First, any gift to a relative is treated by HMRC as a sale at its full market value. Second, for any significant asset, you need a formal, professional valuation. A quick guess won't do. And third, there are special rules and reliefs that can save you money, but you've got to know they exist to use them.
Of course, it's really important to say that this has been a general guide. Tax law is incredibly complicated, and everyone's personal situation is different. That means it is absolutely essential to get professional advice that's tailored just for you before you make any big financial moves.
And for that kind of expert professional advice, you can reach out to the fantastic team at My Tax Accountant. They specialize in helping people with capital gains tax valuations and all sorts of other tax issues. And give them a call on 02 08 570 8531 or drop them an email at info@mytaxaccountant.co.uk. When it comes to tax, what you don't know really can hurt you. Thanks for joining us.